Yo, what's going on, everybody? It is Monday, March 31st, end of the quarter, and it was a really lousy quarter for equities. Good quarter for gold. As a matter of fact, it was the best quarter for gold since 1986. Yes, I was a trader down on the NYMEX, and I would trade gold as well back in the day in New York at the World Trade Center. The Twin Towers, man, they should have rebuilt those Twin Towers. Every time I look at that generic, skyscraper that they put up, just like has no character whatsoever, like the Twin Towers were iconic. They should have just rebuilt the damn Twin Towers. That would have been the best fuck you to the terrorists. You knock them down, we put them right back up. Anyway, I digress. Folks, I cannot wait to short gold. I am chomping at the bit to short gold. I think when this ridiculous rally ends, we're going to have a period like the 1980s. Actually, it's funny that they're saying 1986, making the comparison this quarter to the quarter of 1986. Like I was a gold trader back then, an oil and a gold trader. Gold basically kind of languished for 10 years. I mean, it just stayed around $200 to $250 for like 10 years. And that followed the big gold price run up, when the US in 1971, when Nixon took us off the international gold standard, and that time, the dollar was pegged to $35. Gold was pegged to the dollar at $35 an ounce. And then when Nixon broke that peg, through the 70s, we had that gigantic rally. And of course, infused into that was also the Hunt brothers' attempt to corner the silver market. That's a whole other story. And then gold ran up from $35 to $850 an ounce. And then that was it. And it dropped all the way back down to like 200. And it stayed there for like 10 years, man, a decade. There was a lot of gold leasing going on. The central banks had accumulated a lot, and then they were divesting. Actually, I remember that whole period when they were dumping out their gold. And you've had a similar thing happen recently now, since I would say starting really around 2014, and then it picked up a lot with the Russian invasion of Ukraine in 2022 and all the sanctions and central banks getting into gold. But now recently, this parabolic move, and that's what it is. I mean, let's face it, the price is rising because it is rising. I mean, there's no real fundamental. I look at gold as like an economically sensitive commodity and like an industrial metal. I mean, we still have, the fact is that jewelry demand is still the primary demand driver for gold. You have investment demand and whatnot. But it's an industrial metal. And this rally now, how it's been kind of parabolic, as I said, not kind of, it's really parabolic. I mean, at some point it's going to stop, and there's been a lot of gold. There's a lot of gold sitting in COMEX warehouses. There's a lot of gold that the central banks own, and they lease that gold out to earn an interest rate on it. And eventually the price is gonna come down, and it's gonna stay down for a long period of time. Believe me. And so I'm just waiting. Fiscal flows have been very strong. I tell you guys that every day. And that's part of what has been behind the rally. And there's also this fixation or hyper concern about inflation because of the tariffs. I'm a skeptic on that. I mean, everybody is saying that the tariffs are going to be inflationary. I'm a contrarian by nature. I mean, that's just how I'm built. And if everybody is saying that this is going to be the outcome, I mean, I find it hard to hold myself back to go against that outlook. We'll see. We'll see. But I am chomping at the bit to go short gold. I don't think it's necessarily time right now, but we're getting close. I think we're getting real close. Let me mention that, I compile my MMT trader report on the weekends. And so I have time to sit quiet and go over all the data. There were some things in the data, which I pointed out in the new issue that came out, yesterday to my subscribers. There were some things in the data that, caught my attention in a way. I'm not going to get into that now, but it caught my attention. It's something that I want to keep an eye on. It may be an early indication of something. Maybe it's not at all. Maybe it's just, one of these things where it's a calendar issue and it'll all get straightened out, because when I look at year over year comparisons, sometimes you could get a little blip or a little dip because of the calendar. Dates don't line up exactly with, when there's a Social Security payment or when there's a first of the month payments going out, stuff like that. But it did catch my attention. April 2nd, which is Wednesday, that is Liberation Day, right? That's when the tariffs go on. The government starts collecting the money as of April 3rd, and we'll see what happens. Like, that data is in the daily treasury statement every day, so I can see what's happening there. And like I just said, there were some other things that caught my attention that I want to keep an eye on. So tomorrow is April 1st, April Fool's Day. That's first of the month payments day. That's the first of the month payments days are very, very big flows. And I think we got to talk about this now because, I've been telling you guys, and what's been happening, I mean, we see it happening, is that, in the past, those big flow days like April 1st and Social Security payments and quarterly interest payments and stuff like that, but mainly the first of the month payments, because that's huge. We're talking about leading flows. They could be like 120 billion. Net flows could be like 80, 85, 90 billion in a day. It's huge, But what I've been explaining to you guys, and actually what we have been seeing happen, is that these big flows, these big reserve deposits into the system have been very destabilizing. I've been talking about that now for weeks, if not longer. And that all comes back to the debt ceiling and the fact that, Treasury is now constrained in its ability to, drain reserves down to a more manageable level because of the debt ceiling. And so when you get this big reserve dump, if I'm going to go to my bilge pump analogy again, tomorrow, big wave crashing into the boat, filling it up with water. Now, today we had a nice little snapback off of the early weakness. Dow was up, S&P was up, NASDAQ just down a little bit fractionally, but it was down big and it came back. So it's kind of like a rubber band snapping back. I mean, that momentum combined with the fact that everybody panicked leading up to April 2nd, Liberation Day, so to speak. Maybe we get some, still a little bit of momentum in this rally tomorrow, but I'm skeptical because these flows, that's like poison to the market, okay? It's like getting bit by a rattlesnake. You can survive it, but it's not pleasant. So if we do get a continuation of this snapback that happened today, I don't suspect that it's going to last very long. And I would be more inclined to sell into that because I think that we got a problem here. We got a problem with these, with the debt ceiling and the, what that is, the effect that's having on the system. And when I say the system, I'm talking about the banking system. We got a problem here. And, I keep saying that we can't be confident of a sustained rally in stocks until they raise the debt ceiling. And then there's these other little things that popped up over the weekend that I saw, which I wouldn't say they're anywhere near critical right now. I mean, it's kind of like if you're driving around in your car and, you're way past the time when you need an oil change, but the light hasn't come on yet. Or let's say you're looking at the temperature gauge on your car and it's a little bit higher than what it normally is. You pay attention to that. Maybe it's nothing. Maybe you need some coolant. Or maybe your head gasket is starting to blow. I don't know. So we got to raise the debt ceiling. And then there's those other little things that popped up that I just need to keep an eye on. All right. So if we do have a continuation of this snapback today, which, listen, let's be honest, the flows are still very, very strong. So that could happen. But it's limited in its ability to sustain any rally because, look at what the banks are doing. In the last 2 weeks, they shunted off 110 billion into the reverse repo facility. They're like having to dump off these deposits into the Fed's RRP because they're choking on them. They're choking on these reserves. And Congress is sitting there doing nothing. Secretary Bessent, I don't even think he understands it, to be honest with you. He's kind of a quiet dude, if you ask me. Compared to somebody like, by the way, Donkey Face, you don't see too much of him lately, like in the past few days after he made that comment last week about, oh, it's no big deal if people don't get their Social Security checks. My 94-year-old mother-in-law, she wouldn't complain. And by the way, anyone who complains, you know what? That means you are a fraudster. That means you are committing fraud. I think somebody in the White House sent them the message from Trump to, hey, dude, just shut your trap for a little while. I haven't seen the guy. But anyway, Bessent, he's kind of a quiet guy. Even when he speaks, do you find it? Even when he speaks, he sounds like a kind of a quiet guy. So he's not out there like pounding down this idea that, hey, Congress, you need to raise the debt ceiling. We got a problem going on here. I don't think he understands the problem, to be honest with you. Because when it's been proposed, I think I spoke about this. Lawmakers in Congress have been talking now for a while about eliminating this rule in the supplemental leverage ratio that reserves and treasury securities have to be capitalized. Like this was close to getting done. And he came out and said, he was asked about this, I think, a few weeks back. And he said, we just have to do rigorous analysis on the regulatory structure. What the hell does that mean? We have to do, he was giving a speech at the New York Economics Club. I think that's where it was. And he talked about this. And basically, his actual comment was, we have to do rigorous analysis on the regulatory structure. What the hell does that mean? Either you say, look, we don't need to make this change, or yes, the change is under consideration, and we're going to have a decision on this, at X point of time. I mean, you don't see Elon Musk, for whatever you want to say about the guy, he's very decisive. And if he fucks up, if he makes a mistake, he says, "Oh, I screwed up. We made an error. We're going to correct it." But one thing you got to say about Elon Musk is that he's not wishy-washy. He's not indecisive. The guy is like hyper decisive. He makes decisions like he reminds me, this is Churchillian. Winston Churchill was like this. He never thought twice about a decision. His attitude was, you make a decision, you let the chips fall where they may, and he made a lot of bad decisions. But like his mantra, his belief was that you work it out. You make a decision and you work it out. Not this freaking, we're going to do a rigorous analysis of the regular. What the fuck does that mean? What does that mean? What the hell does that mean? I don't know. Like, dude, you need to change this rule because it's ridiculous. Not only do we have to go through the damn debt ceiling every 2 years with the instability that causes, and the needless instability and needless volatility. And not only do we have to go through the needless volatility caused by these doofuses at the Fed who we got to raise rates, so maybe we won't, maybe we will, maybe we won't, maybe we will. Set rates at 0 and leave them there. Let Fiscal regulate the economy, all right? But now we got to worry about a regulatory structure which is not robust at all. It has holes in it from top to bottom. Every time there's a problem, the Fed or the banking regulators or controller of the currency has to come up with some kind of patch because it's so screwed up. It's not a rigorous structure. It has to be dealt with. And you can't have a guy who's Treasury Secretary saying, we're gonna look at it closely. What does that mean, man? What does that mean? We're gonna examine it close. I mean, it's been looked at up, down, and sideways. When was this put on? It was put on I forget when. Was it during the pandemic or something like that? But anyway, it's been on for years, this rule. And so and it's also been under consideration for change over that period of time. So it's ridiculous, man. Anyway, tomorrow, then we got Wednesday with the tariffs. And Thursday is when government starts collecting the money. So we're going to see, because that shows up in the Treasury statement. We'll see. I don't think the market's going to do much on the upside. You're going to get these snapbacks because the fiscal flows are strong, but unsustainable with the situation right now with the debt ceiling. Unsustainable. And then there's those other things that I've been talking about. Anyway, that's it for today. It's getting a little dark, man. I should have went inside. Please like and subscribe. And don't forget, go to my website, pitbulleconomics.com, and sign up for a 30-day free trial to MMT Trader. See you tomorrow. Bye.